Hi, everyone, and welcome back to Stephan Livera podcast, brought to you by Bolt, the best place to buy, save, and store your sats using the 2 of 3 multi-sig. You can find that for American listeners over at getbolt.io. Now, joining me today is Dr. Jeff Ross. He is at the hedge fund Vailshire Partners, and of course, well known for his commentary on Bitcoin and macro things. So, first of all, welcome to the show.
Hey, thanks, Stephan. I'm really happy to be here. Thanks for having me on.
So, Jeff, I notice you've made the big shift. You've gone from bull crab to bull. So let's start there. What's driven this big shift? And I know a lot of people in your comment sections have been annoyed that you've been up until recently in the bull crab camp. And so what's driven this shift?
Sure. So so let me first explain how I do things and how I think about things as a fund manager. For me, it's all about liquidity. I think that ever since the global financial crisis back in 2008, 2009, that was the time where the central banks and especially the Federal Reserve basically wrested control of the markets away from the business cycle a little bit and basically took over, and liquidity became all important. So that's why I focus so much on it. A lot of people get sort of upset with me why I talk about the Fed so much. You know, who cares about central banks? We hate central banks, don't we? And I'm like, yes, I'm all on board. I don't want central banks. I don't think we need central banks. And I think Bitcoin negates the need for central banks into the future. But for now, it's the system that we have. And so the flows of liquidity, to me, are what drive asset prices. They especially drive risk assets like equities, and they especially, even more so, drive the price of Bitcoin, which I call the great absorber of liquidity. Okay, so I have 5 stages of how I think about liquidity flows. And I start the lowest is bear. So I go from bear crab to bull crab to bull at the top. Okay, and these cycles are basically these sine waves where you have business cycles where you can watch what economic growth is doing, where you can watch what inflation is doing, and where you can watch what liquidity flows are doing. And then one other point, and then I'll get back into why I transition from bull crab to bull. The other thing that's really important to know is that the flows of liquidity, so when we're talking about that, basically what I'm saying is, are the flows going from the people to the government, or are they going from the government to the people? And if they're going from the people to the government, like they did back in 2022, what that does is it sucks out all of the oxygen out of the room for investments. And it basically makes it so everything slows down. The economy slows down. That can drive down inflation. So you actually can get deflation. Those are when recessions tend to happen. And it's basically the government saying, you know what, we're going to take all that liquidity out of the room and we're going to slow everything down. And it actually works. It actually happens. That's why 2022 was such a terrible year for so many investors. And that's why we had another huge drawdown in Bitcoin.
Yeah. Can I just ask a quick question just on the liquidity framework, just to understand how you're seeing it? So when you say, you're focused on liquidity, when you say that, are we talking here about things like M2, as in the money supply numbers, M2, or what about, as an example, things like when the government engages in a lot of spending, like it did during the COVID tyranny years? When the government engages in a lot of spending, that may not necessarily have as much impact in terms of M2. It can, but the government can just engage in a lot of spending. How does that come into the liquidity framework you're talking about?
Fantastic question. So when we're talking about things like M2, so I like to follow the global M2 monetary supply. And just so your audience understands, what does that mean? That's basically the cash that is circulating, like physical cash in the system, checking accounts, banking accounts. It's also talking about retail CDs, certificates of deposits, and money market funds for retail investors. So basically, M2 is what is the money supply, the liquid money supply of regular people. Okay, so when the government spends, fiscal spending, that's a concept we talk a lot about, and there's been a lot of fiscal spending recently in the U.S. over the last couple of years, which is why, by the way, I think we averted a recession in the U.S. That can go to either businesses or government kind of mandated places. It can also go directly to individuals. So to your point, what happened in COVID? They shut down all the businesses. The supply chains were ground to a halt, and then they infused Americans' checking accounts and savings accounts with direct deposits from the Treasury into American bank accounts.
Right,
so
like STIMI, PPP loans, etc.
Exactly. So that causes a rise in M2, right? Because suddenly now their checking accounts and savings accounts are flush with cash. That's why we had that, by the way, and I was saying back then, this is going to cause a massive spike in price inflation because you suddenly have less goods and services available and you have a huge amount of new cash chasing after those goods and services that are in limited supply. And that's where we saw the CPI spike up to about 9% or so. The government doesn't have to spend money and doesn't have to put it directly to citizens. Those are called transfer payments. They can spend it on other projects, right? Like they're building out semiconductor plants. That's good for the economy and good for businesses in general. There's lots of other things, and they waste tons and tons of money. Lots of those things aren't actually beneficial for people and for global M2. And then one last point, kind of what we're talking about. There's a difference between U.S. net liquidity, which talks about the Fed's balance sheet, and it also includes the overnight reverse repo market, as well as the Treasury general account, which is like the checking account for the Treasury. That's sort of different, and that's really interesting. That tends to play out, it tends to affect the flow of assets into U.S.-based assets like small cap, micro cap stocks, and mid cap stocks. Global M2 tends to affect global assets like Bitcoin, like gold, and actually interesting, like big technology stocks in the U.S. Those have become basically global safe haven assets, and so they follow the path of global M2. So I don't know. This is kind of confusing to people, but hopefully it makes sense. Basically, if you're seeing the flow of liquidity start to increase away from the government to the people, that tends to portend for good times for risk assets and especially for Bitcoin. And now getting back to your very original question. Yeah. So did I transition? So yes. So I was bull crabbish. And basically when I say I'm crabbish, what I mean is chopping sideways. So choppy sideways movement is called crab-like movement, kind of from a sort of a technical term. We've been chopping sideways because U.S. net liquidity has been chopping sideways for about 3 years or so, and global M2 had been chopping sideways for about that same amount of time. Again, they're all just trying to recover from what happened back in 2020 and 2021 with these huge stimulus measures that happened from both central banks and the Treasury as well. Okay, so here we are now. So what happens is just recently, global M2 has started to break out. It's actually not because of what the Fed is doing. But there are some things sort of indirectly causing that. The Fed just lowered the federal funds rate. In the United States, all of short-term debt services are based on what's called the prime rate. The prime rate is based directly off of the federal funds rate. So when the federal funds rate dropped just recently from 5.5% to 5%, the U.S. prime rate dropped from 8.5% to 8%. So for Americans who have home equity lines of credit, like HELOCs we call them, credit card debt, or small business loans, also what happened instantly, literally the next day, their interest rates should have dropped approximately 0.5%. So what that does is it's a positive effect on cash flows, right? So if you're paying whatever, $2,000 a month for your HELOC or some credit card debt or something that you had, or a small business loan, suddenly that probably dropped by a couple $100. So it's beneficial for cash flow. So now Americans suddenly have a little more cash that they can put into riskier assets like Bitcoin or stocks or whatever. It also affects, a weaker dollar, and lower interest rates are good for anyone around the world that has U.S. dollar denominated debt, because now their currencies are stronger relative to the U.S. dollar. It makes it easier for them to pay. They have more money left in the bank, and the interest rates just are lower themselves. So it's a positive exchange rate, and it's a lower interest rate. Because of all that, that's why we see global M2 rising, and that's why that's positive, and that's why I'm officially bullish now.
Okay, great. So look, there's all these different factors out there. As you mentioned, we were talking a bit about the Fed funds rate. There's a little bit about what is the US government doing? Are they doing a lot of, stimulus checks or buying a lot of things? Now, we can sort of step back and understand now, ideologically, I think it's a bad thing for the state to take more, let's say, private sector resources and take more, control or commandeer more things. But there's understanding, obviously, what I ideologically want to happen and what I see as what is actually happening right now, and what does that portend for, number go up, or does that make number go up, right, ultimately? So I guess that's kind of, as I'm understanding your framework here, it's sort of zooming out, looking at M2 at the global level, not just in the US, but globally, and understanding, well, there's a lot more liquidity. That money is ultimately going to find its way into quote-unquote risk assets. So people are, per se, going further out on the risk curve. They're looking for more. They're looking for yield. They're looking for return. And obviously, Bitcoin is a big key bucket to receive some of that liquidity, let's say. And so I guess when we're talking about what kind of regime we're in, we also have to think about, are we, okay, this is my next question. So are we going to be in a, in your view, do you believe we're going to be in like a sustained increased liquidity environment, or can this just be a blip? And with that as an example, if it's just a blip, does that mean you're going to flip from bull back to bull crab, or do you think there's going to be a sustained, a few years period of time?
So I think it's sustained now, and usually the way these work, so we're already in this new cycle where global M2 is starting to accelerate again. We're starting to see central banks lower rates in general. I think from an economic perspective that the economic business cycle, especially here in the US, has already bottomed and is starting to increase again. That's generally positive. It lasts, though. How long it can last is up in the air. It's hard to predict that. But in the past, since the global financial crisis, these cycles last about 4 years or so. And so since we're already into it, what I anticipate is that we'll see continued acceleration of global M2 all the way into basically the fourth quarter of 2025. Where at that point, I think it'll probably start peaking and rolling over again. I actually think our biggest risk right now, because we're starting to see economic growth here in the US, that's going to surprise people, right? There's a lot of doom and gloomer recessionistas out there who are still calling for the big recession. I know one guy who's saying within the next couple of weeks to months, we're going to have a crash greater than 1929 because things are so overvalued. And he's not wrong. Things are overvalued. But I think the bigger risk is to the upside, that we're going to have kind of a late 1990s style melt up. Because now the central banks are actually getting dovish. Now liquidity is starting to get injected into the system, both from a global M2 perspective and central banks sort of backing up the markets and allowing the economy to start to grow again. And then we just got an announcement yesterday that China is officially kind of getting on board bigger time. So they've already been doing a little bit of like stealth liquidity injections, but they're starting to get into it bigger time now. All of that really portends to a great cycle that I think will last basically starting now into the fourth quarter of 2024 and then last all the way through 2025. And my guess, if I had to guess, I think it's going to peak somewhere in the fourth quarter of 2025 before it rolls over again.
And when you say peak, are you just referring to Bitcoin or just assets in general, like Bitcoin and let's say the S&P or even the Fantastic Seven or whatever they're calling it?
Sure. So when I'm talking about peaking, I'm always talking about liquidity. So and this global M2 stuff. So I think that peaks, but like I said, Bitcoin as the great absorber of liquidity is the most acutely aware of what's happening. So you follow. So people always ask me like, how do I follow your liquidity? How do I follow what M2 is doing? I said, just watch the price of Bitcoin. Bitcoin will tell you when liquidity is going to start transitioning from where it's accelerating to where it peaks. That's when you want to start being nervous, and that's where I'll start switching over into bearish tones, and then that'll officially roll over. And once it's rolled over, everybody knows we'll be talking about recession again, and the stock markets will be crashing. Stocks tend to be a little more delayed relative to Bitcoin, but they will catch on eventually. That the liquidity is coming out of the market. And basically, it's just people shifting back from the further end of the risk curve, and then they go into safety measures. They go into cash. The dollar will get stronger again because everybody's seeking the dollar. They're selling their risk assets to buy the dollar. And it's very predictable. These cycles tend to be predictable once they start. You just have to know where you are in the cycle.
I see. And so the other comment a lot of people will make is that, look, things are overvalued, as you pointed out, and people look at numbers like the Schiller case CAPE ratio as an example, the cyclically adjusted price earnings ratio, and they might say, look, stocks are already at this very high level. Look at how crazy Nvidia is, or Tesla, or some of these ones. Can it really pump more? And I guess your answer, as I'm reading you, is that just like the dot-com bubble or the Japan bubble in the late 80s, yeah, it can, and we can pump harder for now because of this liquidity factor. But eventually, that hits a limit, and then we take the drop from there.
Yes, and so I come from a value investing background. That's how I started out my hedge fund. It was just like a value-based healthcare and technology-oriented hedge fund. Value investing, traditional value investing, the way Buffett talks about it, the way securities analysis talks about, it just doesn't work anymore. And it's not because that's not a good system, but it's because the central banks have taken control of the markets. And so what matters is not what the multiple is. So like, it's not about finding a cheap stock with a, a low PE or a low price of sales or price to cash flow, whatever metrics you want to use to assess value. What matters is are the multiples expanding or are they contracting? And if you have expanding PEs, that's because liquidity is expanding and it's causing people to go further out on the risk curve. So to your point, like stocks were very expensive in 1998. And then they just exploded higher for the next 2 years and went to just obscene levels of valuation. And I think that same thing can happen again. We're already at these valuations by some metrics, by the CAPE, as you're talking about. Price to sales metrics are very high for a lot of the US stocks. I think they can go much higher. And I think they're going to be irrational longer than some short sellers can remain solvent. And I think that's what we're going to see for the next year.
Now, Jeff, you made another comment around how the recessionistas are wrong. So I think that would be great to maybe dig into that a little bit further. Now, perhaps maybe a counter argument there might be, and I think you might be correct, but just for the sake of argument, let's see if, somebody came back to you, Jeff, and said, look, actually, there's a lot of people struggling right now, or, people can't afford a house, this kind of thing. What would you say to that, like this idea that the middle class is disappearing and it's kind of becoming a story of the haves and the have-nots, and if you have assets and you're rich, you're kind of rich getting richer, there's this kind of effect, right? Do you think that that's maybe something more at a social level and not as much of an economic level?
Yeah, so I think this is a long-term secular problem because of our monetary, right? Because of fiat currency, that's a credit-based system, and you alluded to this. If you are an owner of assets, you will get richer, and the rich get richer because you own your house and you have equity in your house and you own stocks and you own Bitcoin, versus the renter class, right? You rent a house, rents have been going up, prices of everything have been going up. You don't own stocks, so your net worth hasn't been going up. You probably don't own a lot of Bitcoin, so that your net worth in general isn't going up. That's a problem with the money. And I know you know this. This is a broken money issue. And it basically destroys and guts the middle class, and it creates these two tiers I talk about all the time, the K-shaped economy. We continue to have that. It continues to get worse and worse, and that will continue, I think, until there's literally a regime change, and it's usually a serious regime change, like a war. Could be a civil war, could be a major world war or something. Something needs to happen to reset the monetary system, because for the lower income renter class, it's almost insufferable right now. Like, they're barely making it right now with multiple jobs. They can barely afford groceries and transportation, whatever else. Something has to change, and I think at some point a revolt will happen, and it will change. And again, and we could talk about that if we wanted to, but Bitcoin fixes this, right? If you have a proof of work system that doesn't allow for these massive income shifts, we're going to see the K-shape is going to close, and we'll build up a new strong worldwide middle class based on Bitcoin and based on proof of work. I can't wait for that day, but we're not there yet. And I think we need to see a collapse of this system first, and the collapse is going to be ugly. So what I'm talking about, that's a very long-term trend. It's been happening started around the end of World War II, and it's been just getting worse and worse and worse and worse. And it got a lot worse, obviously, in 1971, with Nixon removing the dollar from the gold standard, because now there's nothing holding fiat back from just being nonsensical. And there's no accurate measuring stick anymore. So, yeah. So that's different. So that's a long-term trend, and that's not going to get better anytime soon until we actually fix the money.
Right. Yeah, and I think you're right on that analysis. That while there can be social issues that we all acknowledge, at the same time, there's haves and have-nots, and in this kind of liquidity going up environment, numbers are going to go up, and that means people who have assets, they're going to do really well, and then on paper, it's going to look like, oh, wow, GDP number go up, everything's great. And then that's kind of where, let's say, people are watching two different movies, right? Because if you have assets, you're watching the numbers go up and you're like, oh, wow, I'm getting richer. It's great. Look how good life is for me. And of course, if you are in the regime at that time, you want to play that story up, right? Like if you're in the regime, you're going to say, look, the numbers are going up. We're doing a good job for you little plebs. That's what they're going to try to, that's what they're going to try to say. And then if If you're on the have-not side of that equation, your life is getting worse. Your quality of life is getting worse. The quality of things that you can afford, the groceries you can afford, the place that you can afford to live in, the car you can afford, all these things is getting worse.
Yeah, and it's a problem. And the problem is, and this is another thing, by the way, I hear a lot of people blaming the central banks for these problems, but really what the problem is unbridled spending by the governments, because that's how it all starts, right? So the governments basically, like the US government, we really don't have a debt ceiling right now. They can spend as much money as they want. When they say, hey, we're going to spend this billion here and these hundreds of billion and this $1 trillion here, the U.S. Treasury just has to say, okay, we're going to create a bunch of new treasuries because of this. And then the Fed, despite what they talk about their dual mandate, what I really believe the Fed is they are the buyer of treasuries of last resort. And so the market will continue to absorb these treasuries as long as it can until it just says, you know what, we can't do it anymore. We don't want these treasuries anymore. And that's where you have a little bit of calamity for a week or two. And then the Fed steps in, and that's when quantitative easing starts again, and they start putting these treasuries on their balance sheet. But the whole problem and the whole reason why we have income inequality, despite what the politicians say, and they just lie through their teeth, or they're stupid. They're either stupid or they're lying. They blame greedy corporations, and they blame Republicans, and Republicans blame Democrats. All of it is just a spending problem. They're spending more than they take in. Most people understand that if you do that, you can't do that for long. You can't keep borrowing on credit cards if you're not making enough income to pay off your credit card debt. Eventually, you go bankrupt. And so because the U.S. government can print money, they can't go bankrupt. And all we see is this continued divide, this continued wealth inequality, and it gets worse and worse. And it's very frustrating to watch when you know what's happening underneath the hood. And it's also frustrating because most young people or people who just haven't taken the time to learn, they believe what the politicians say. They believe it's the greedy corporations that are making their lives miserable, or they believe it's the grocery stores that are price gouging. It's just pure nonsense, but that's what the newspapers say, so they just repeat it.
Yeah, and as you said, on the same topic of US government debt, everyone's seeing those numbers going around now. I think it's 35 trillion last I saw, and the other factoid that goes around is, oh, look, the interest payment is more than the amount that the government is spending on the military, right? And, these huge, massive numbers in terms of the amount of spending on social security and healthcare and, these huge items. Where does that go? What does that mean for, the global economy if the US is not able to deal with this debt situation in an honest pathway?
Yeah, well, they won't deal with it in an honest pathway. So what they're going to keep doing is just keep printing. I will say I deviate from a lot of my colleagues in the space who talk about this runaway debt, this debt crisis and the death spiral. I think the U.S. can continue doing this for decades, and I don't think we're at risk of the dollar collapsing anytime soon. I do think lots of other countries are going to collapse. We've talked about that a lot, where I believe hyperinflation is real. It's happening in other economies, and it's only going to get worse in tons of countries around the world. And as that happens, that means the collapse of your fiat currency, and then that purchasing power has to go somewhere else. Most of it will migrate into the dollar. Some of it will head into the BRICS contingency as well. But the dark horse, obviously, is Bitcoin. And more people are starting to store their purchasing power in Bitcoin. And I think that just obviously is going to continue to grow at a very fast pace and start to catch up. But so where does it end? It ends in hyperinflation and the death of a currency. But the US dollar is and will remain, until further notice, the strongest currency in the world, the best currency in the world. So I don't see the US dollar collapsing like anytime soon. Maybe if there was a massive if we have World War III, and basically our printing got to be just out of control at that point to pay for financing this war that people don't want. That could lead to US dollar hyperinflation, but short of that, I don't see that happening anytime soon.
The lead sponsor of this show is Bold, the best place to buy, sell, and save Bitcoin. For listeners in the US, Bold lets you secure your financial future with complete peace of mind by integrating a low-fee, Bitcoin-only brokerage with next-gen multi-sig vaults. With Bold, you can smash buy Bitcoin or set a DCA plan for only 0.99% fees and seamlessly deposit the Bitcoin direct to your Bold vault. The Bold Vault is a 2 or 3 collaborative multi-sig where you hold 2 keys and Bold holds 1 as a redundant backup, protecting against loss or theft. You can use Trezor, Ledger, or Cold Card hardware wallets to spin up a Bold Vault in just a few minutes, and the Bold Vault is the only collaborative custody vault available with 0 monthly fees. They're also offering 0 fees on your first $10,000 of Bitcoin buys and $25 of free Bitcoin when you buy $100 of Bitcoin or more. Try Bold today and upgrade your stacking experience over at getbold.io. This show brought to you by CoinKite.com, the creators of the best Bitcoin hardware security devices such as the Cold Card Mark IV and the new Cold Card Q. Now, we use Bitcoin hardware security devices to keep our keys offline, our private keys offline. Now, the way these work is you can do that setup, write down your 12 or 24 words on the seed word cards, and keep that secure. Now, you can use this device to interact with the Bitcoin network using software such as Sparrow Wallet, Electrum, or Vector Desktop, or Nunchuck as a few examples. Now, you have a range of security features that you can use with these devices, such as passphrases, you can use seed XOR, or my favorite is multi-signature. Now, if you're starting in a basic way, just start with the device and the USB-C cable, plug it directly to the computer and use it that way, and then later improve your setup. But I believe these devices are great at helping secure your coins, especially as you start to migrate up into multi-signature security. But don't be disheartened or don't be scared away. They are accessible, and I think you actually do learn about Bitcoin in the process. So to get yours, go to coinkite.com, use code Livera to get a discount on your cold card. And now, back to the show. I see, yeah. So it's essentially kind of related to the whole dollar milkshake idea, but of course there's Bitcoin at the real end of it all.
Right.
And so people talk about, BRICS currency this and that, but ultimately are governments and central banks going to hold someone else's paper? Are they going to hold someone else's debt instead of the US government debt? Are they going or something else? Now, it is fair to say, and I'm sure you're familiar with those numbers as well, that people have spoken about how it is waning over time, right? Like I think that number went from something like 72% to 58%. I can't remember the exact number, but it's like the percent of US government treasuries that are held compared to others. So it is waning, but it's, to your point, it's still the least bad, and that's why a lot of these central banks are still going to hold that, even though they make overtures and they make statements about, we're going to do our own BRICS currency, we're going to do our own thing, but in practice, it seems that the US still kind of rules that particular roost.
Yeah, exactly. And I definitely think if you look at the times and you take the 30,000 foot view, we're definitely in the final stages of this fiat currency experiment. It's been a wild experiment. It's been greatly beneficial to the US in many ways. But now we're starting to see that Triffin dilemma start to take place, right? The US no longer has a middle class. We don't have a manufacturing base anymore. We've exported all of our manufacturing around the world. China predominantly, Asia predominantly, some in Mexico, but not so much anymore. And we're starting to see the downsides of this. Like, it's great that we can export treasuries and the whole world funds the U.S. military. That's basically what the system is right now. It's all based on the dollar, the petrodollar, sort of, where everybody has to hold treasuries. But to your point, people are less and less inclined to do this, and even U.S. officials are starting to say, you know what? The benefits are starting to shrink relative to the downsides of this. And so maybe we need to start thinking about something else. And I think that's why it's actually even a discussion that we should have like a Bitcoin strategic reserve. I know that a lot of people on the left think that's just insane that Trump said that or RFK Jr. said that. But that's the way to think about this. They're starting to think about a transition away from this dollar-based system where the U.S. dollar is the world's reserve currency and unit of account, and start to think, well, if it's not the dollar, what else could it be? What could we do so that we don't just collapse as a empire, but can still maintain our clout around the world, basically, in our position without just completely collapsing. And to me, it's super obvious that Bitcoin is the answer. And it's encouraging to see the political leaders talking about it, but I still think we're kind of years and maybe a decade or so away from that becoming a reality.
Yeah, and I agree. I think we've got a few more cycles to go of this kind of, craziness with Bitcoin.
Mm-hmm.
And to your point around the hollowing out of the middle class, and, I think it's fair to say the US government and the US people have arguably, in some ways, benefited because a lot of people around the world were effectively paying for the US government and for US people to enjoy, let's say, an artificially advanced living standard. Because there are all these people around the world without knowing it, their government was taxing them to buy, guess what, US government debt. And so it's sort of that net effect results in US, people living in the US and US citizens kind of living a bit larger than they would have otherwise if everybody was kind of living within their means and, on a sound money standard, hypothetically. So I'm curious as well, like if we're talking about, okay, it's kind of, your framework for looking at things is liquidity. Are we in a increasing liquidity or a decreasing liquidity? Now, I'd love to talk a little bit about behaviors. So in a high liquidity regime, what kinds of behaviors are we going to see? Are we going to see more leverage? Are we going to see more crazy business ideas engaged in? Are we going to see more, VC? I'm curious if you have any thoughts on that. What are the typical behaviors that signify or that we see in high liquidity environments?
Yep, 100%. So leverage is the first thing that I look at. Leverage increases as the bull market rages on. Everybody feels like they're brilliant during a bull market because all of your assets are increasing. Your nominal net worth is increasing markedly. So you have that wealth effect where everybody is feeling good. Home prices are rising. Equities are rising. Bitcoin, I think, is going to go to the moon again. Those kind of things. But what happens is people start adding to leverage, and they think, "Man, I just made 100% quickly because I used leverage. What if I tripled down on my leverage, for the next 6 months?" And that works until it doesn't, and then it collapses and it gets terrible. So basically, easy money begets stupid behavior and more risky behavior. And the longer it goes on, people can make a lot of money, and that's where you get those exponential moves higher, or the hockey sticks higher that you see in Bitcoin. You can see that in tech stocks as well. Tesla, these kind of stocks, they can hockey stick as well still. That always, though, means that we're getting close to the end. And so that's where you have to start getting cautious. That's when I'll probably start counseling people to be careful, to consider, buying puts instead of buying calls, those sorts of things. That's the downside of all this stuff. So you also mentioned VC. What's interesting is in the last cycles for the last 15 years, interest rates have been so low that basically any dumb business idea could get funded by cheap debt, because if you have the cost of capital near zero, these very low interest rates, you can do whatever you want because there's basically no risk to you not being able to pay back your zero interest rate payments. This time around, though, I don't think interest rates are going to go that low. And so I think we're going to see a shift from sort of debt funding to more equity funding. I think venture capitalists are going to focus more on obtaining equity in companies. And they're going to have a little bit more proof of viability this time around because interest rates are a little bit higher. So venture capitalists will be taking a little bit more risk in these early stage companies than they have in the past. So all of that behavior is very similar. I think the only big difference relative to a decade ago is the interest rates. So because debt is more expensive now, and I don't think it's going to get nearly as cheap, that just means that you're going to see that slight shift away from debt into equity, and people having a bit more discerning approach to how they value these early stage companies.
I see. And that could also play out in the sense that venture capitalists, because most venture capitalists, unless they're like a rich angel or someone, they're often not investing their own money. They're going out and sourcing investor funds. And where did those investors get their money? Often from, historically, that in the last 10 years, that's been because of the low interest rate environment. Because we're swimming in this environment, and people don't really realize that. And so they think, as you said, we all think we're geniuses when really it's kind of liquidity has been going up, and almost anything does well within reason. And so what we might see then is those venture capitalists, as an example, will have less LPs, less people signing up to give them money because there's not, the money is not as free flowing as it was. But I guess to your point about the interest rates, so are you seeing it then like the Federal Reserve is going to keep lowering, but just not as much as historically? So you think it's going to go to like 2 or 3%, but not 0? Yeah,
I think it will be limited. So I think the Fed funds rate, maybe by the end of this year, it actually gets down to 4.5%. So a full basis point lower, 100 basis points lower, full percentage point lower. And then I don't think it's going to continue into 2025. The markets are predicting that it's going to go much lower. that's where I diverge from them. I think they're wrong. I think what we're going to see is inflation is going to actually start picking up a little bit. Like it's probably going to bottom September, October, right around now. I think the next CPI release is kind of mid-October. That will talk about what happened in September. To me, that's probably going to be a low point, and then we're going to start seeing inflation start creeping up again. And I think this range of interest rates, sort of in the 3 to 5 or 4.5%, are basically the new norm. And I think we will see that for at least probably a year or maybe two until we have a big deflationary bust, which is, I don't think would happen until probably 2026 or so. But until then, I just really don't think we're going back to zero. And then one other point is, I see a lot of people, or when I was on Twitter, I nuked my Twitter account, but so I'm just on Nostr now. But before I left, I saw tons of people overlaying the 1970s double inflation cycle with what we currently have, and they say we're right at the precipice of this happening again. And I think they're going to continue to think that they're right, because I think inflation will bottom and maybe start to creep a little bit higher. But I definitely do not think that we're going to go to another massive inflation spike like what we saw in 2022. I don't think we're going to go back up to 8, 9, 10% or higher, as some people are saying. I think inflation might go up to, say, 3% or so, but be kind of uninteresting after this. I think we're through that inflationary impulse.
I'm curious there, because coming back to the US government's debt position, don't they effectively have to create a lot of printing to sort of print their way out of the debt? Are you saying it more like they're going to do that, but the CPI is still going to stay in that 3% range? How do you sort of square those two?
Yeah, so again, the credit creation isn't necessarily inflationary. So if you have underlying economic growth that is rising and accelerating, that actually kind of eats that inflation and causes, you can have kind of that sustainable level of inflation, but you don't have
and by
runaway inflation.
We mean CPI inflation, right?
CPI, yeah, that's really important. Yeah, so we'll have price inflation of things like of asset. I should say we'll have asset inflation, but not necessarily inflation in the cost of goods and services. To me, those kind of things happen where, like what we talked about, what happened during COVID, is where you have that huge influx of cash into people's bank accounts and then a disruption of the supply chain simultaneously. That is just a perfect recipe for massive price inflation. But I think what we're more at risk for in the next, for the next 12 to 15 months is asset inflation. So asset increasing in prices, stocks, Bitcoin, other things like that.
Interesting. And so then, and that will also tie into people being unable to afford houses and things like that, because the houses are pumping like crazy, but their income is not really going up that much. So that's going to be challenging at the social level. But that'll be that. Also, I'm curious. So with this liquidity framework, would you distinguish that from other ways of looking at things? So as an example, some people just look at it like, okay, just 4-year cycles, or even the presidential cycle, or, other aspects. Do you see them as aligned or, just different?
So I think the only thing that's not aligned, actually, interestingly, is the Bitcoin halving cycle, which I think is sort of a red herring, right? That's a little less than 4 years. It's like 3 years, 11 months in general for the halving. So we're seeing the halving happen earlier and earlier in the year. And that's starting to detach itself from this other, which I think is actually the more important 4-year cycle. The US presidential cycle, it's not that it's like magical or something about the elections. It's because of monetary and fiscal policy that happens as we head into an election, right? Like what they want is, we want to see an improved economy. So there's usually a ton of fiscal stimulus. And then these presidents come in and like day one, they're like, okay, here's all the things we're going to do. And we're going to spend money here and spend money here and do all this stuff. So you get this huge fiscal and monetary impulse once they get elected, and as that becomes into fruition, as whoever wins, Trump or Harris, they're both going to spend just ghastly amounts of money that we can't afford to spend, but it doesn't matter. So they're going to borrow more money to do that, and that's going to cause this big inflationary impulse. And again, inflationary, not prices. It's going to be inflationary for assets increasing. And so they're just going to be supporting the markets, and that's why we see that big, huge impulse right after the presidential election that lasts for about a year or two. Before it turns over and suddenly the reality of everything, like, oh my gosh, we've spent so much money, markets are way overpriced, the CAPE ratio is off the charts, all that kind of thing. We need to pull back the economy, and that's usually when the Fed steps in about year 2 to year 3 and says, you know what, let's raise interest rates, let's slow the economy down, and they basically force a recession. And so you have these cycles that kind of ebb and flow every 4 years or so.
That's fascinating. Yeah, that's actually a really good explanation. I had never heard it put that way, because I've heard people talk about this idea of, is it the presidential cycle? Is that more important than the halving cycle in terms of, economy and NGU and so on? But your explanation actually makes a lot more sense in terms of what is the government doing in terms of spending, how much liquidity are they creating or injecting into the system. So I guess one other area I'm curious if you have any thoughts on is the shift in the narrative with Bitcoin. So as an example, it recently came out that Bhutan, the nation of Bhutan, has been, now it's been known that they were doing Bitcoin mining, but what recently came out is that apparently they've been stacking sats really hard, and now on a per capita basis, it's a lot in terms of probably the biggest nation in terms of per capita sats per person. I'm curious if you have any reactions on that. Is that just a reflection of Bitcoin advancing into public conscious?
Yeah. So I think this is all inevitable, right? This is what we've all been waiting for to happen, and we're starting to see the dominoes fall. And at first, there are these little countries, El Salvador, Bhutan, and we're just going to see that more and more. And I really believe this, and I've said this for several years now, that Bitcoin will change the geopolitical world order. Having a Bitcoin reserve is like it is right now for a country to have oil reserves. So the Middle East, Norway has their famous reserves. The state of Alaska has reserves that the citizens benefit from. There is nothing better for a country to do than to have a reserve of Bitcoin by the government on behalf of their citizens. It will create a huge net wealth effect for the nation as a whole. It will help make paying bills much easier. If you have runaway debt, this is the way to rein that in and to actually start making that manageable again. And so I think it's inevitable. I think it's awesome. I think that at some point, probably 10 to 15 years from now, I think basically all nations in the world will be doing this, that they will have a strategic Bitcoin reserve. To me, that's inevitable. And I think the main reason is because as we go along, say the next 5 to 10 years, and people are looking, everybody knows about the US government runaway debt that they can't possibly pay back with, sound money. But that's the same in all of the major nation states. Any government who can print their own money, they do, and they abuse it until they run their currency into the ground. And what happens is it's the Gresham's law, right? Is that people don't want their cash anymore. And so everybody's going to be storing away sound money, possibly gold. Oil, you can argue, is kind of a form of sound money. It has been for the last 50 years, just like a commodity money. And then Bitcoin, obviously, is the best form of money. And so what I think is going to happen in the next 5 to 10 years is nation states are going to be like, you know what? I don't want your treasuries. I don't want your dollars. You can pay me in Bitcoin if you want to, pay me what you owe me. And if not, maybe a threat of war, who knows what's going to happen. But to me, that's what's going to be driving all of this, is as we look at the success of Bhutan and the success of El Salvador and these other nations that are going to start creating a Bitcoin strategic reserve, countries are going to start demanding Bitcoin as payments from each other. And that will change the world order. Whoever has the most stockpiled they're going to be the lead dogs and the early beneficiaries.
This show brought to you by mempool.space, the world's leading Bitcoin visualizer. And now they've got an accelerator program. So if you have a transaction that you sent at a fee that was too low to get confirmed, now you can fix this with the mempool accelerator. The way it works, you can go and search your transaction, scroll down, click accelerator, and you don't need an account. You can pay with Lightning, and then it'll show you it's now in the process of being accelerated, and then after a few minutes, it's confirmed. And so this is a great way to help you out if you are stuck. And this can happen where maybe your wallet doesn't have RBF or CPFP, or it might help you in situations where it's impractical to go and re-sign. So for example, multi-sig with keys in different locations. And thirdly, even in some Lightning scenarios, perhaps a forced close, you might not be able to use RBF. And so in this case, the mempool accelerator can help you out. So keep it in mind, and you can find out more over at mempool.space/accelerator. And now back to the show. So looking forward then, again, looking in this liquidity paradigm, are you seeing it like, as you're saying, all these assets will go up? So it's kind of like maybe gold will go up, but Bitcoin will go up more than gold? Is that how you're seeing it? So as an example, as we stand today, Bitcoin is what, 1.2, 1.3 trillion, and gold, I think last I checked, is maybe 16 trillion, 17 trillion, something like that as a total market. So where do you sort of see them going on a longer term or medium term basis?
So a couple thoughts is, one is I say a lot that anything that's good for gold is 10 to 100x good for Bitcoin. And so I actually got into Bitcoin from being a sound money guy. I used to be a gold bug. And in fact, in my funds, I used to invest in gold and gold miners and things like that. And so I love to always give credit to gold, is it did a fantastic job of being the world's best store of value for thousands of years in the analog age. But then we switched over to the digital age and everything changed, right? So it wasn't until we got into the digital age where Bitcoin could have been created, per se. And so Bitcoin is now, and we all know this, all of the properties of money, Bitcoin does everything basically better than gold. It just doesn't have the track record yet, but that's getting a little better every year. And so, yes, I think gold will continue to benefit somewhat, although I do think gold will be demonetized by the next generation. I think as the baby boomer generation dies and Gen X is getting too old to matter and the millennials come on, the millennials and younger don't really care much about gold. So I think that monetary premium is going to just slowly get sapped out of gold, and it will be just basically a commodity. It will have its utility value. Maybe 10, 20, 30, 40 years from now. And Bitcoin will absorb basically all of that monetary premium going forward.
Yeah. Go on.
I was just going to say, so if I were going to invest with a 30-year outlook, I would not invest in gold. But I do think for probably the rest of this decade, gold will probably do well for the same reasons that Bitcoin will do well.
Yeah. And certainly a lot of the gold guys are, fist pumping right now at, 2,600 an ounce or whatever it is. So they're all cheering. But I think... I was chatting recently with Andrew Edstrom, and he was sort of making the point that often, gold might pump a little bit, but then Bitcoin will pump, multiples of that. And I can't actually, it might be I might be getting that confused. It might be macroscope, but anyway, similar. I think a lot of people have a similar sentiment on that. So we might be seeing that kind of dynamic play out, where yes, there are central banks around the world buying gold, and maybe certain countries, maybe India and China, where they still like gold, but in practice, longer term, it's going to be Bitcoin, but it's just it's going to take some time to get there. And so there will be times and points in the cycle where the gold bugs will sort of laugh at Bitcoin hodlers and say, oh, look at you silly hodlers, we're doing well on gold. And then Bitcoin will sort of go to the races and outpace the gold return. And then there'll be, that sort of natural back and forth.
Yep. And I think we're at that transition point right about now. Gold has had it's had a very great year. And the last several months have been fantastic. If I were, say, a portfolio manager that just had Bitcoin and gold, I would be greatly trimming my gold position right now and putting, most or all of that into Bitcoin if I were doing that, but I'm not.
Yeah, of course. And then from an asset allocation and portfolio perspective, I'm curious if you have any thoughts, for, let's say, institutional investors or people who are more serious about how they think about their asset allocation. How should you think about Bitcoin?
Well, what I've noticed as a fund manager and a former investment advisor is that the more you understand Bitcoin, the more you know Bitcoin, the more you own Bitcoin. And so, we all know people who think it's just crazy, the idea of putting 1% of their net worth into Bitcoin. They're at this end of the spectrum. And then we know people who are literally 100% allocated to Bitcoin, and that's all they have. And some of them are 150% into Bitcoin because they actually borrow money. They're doing speculative arbitrage or a carry trade to own more Bitcoin on debt. And I'm not recommending that. I'm just saying I know a lot of people who do that. So anywhere you are along the spectrum, obviously, if you look at Bitcoin's historical returns and you look at its Sharpe ratio, its risk-adjusted returns, it's vastly outperformed all other assets since it's existed. If you think that that is going to continue, and I personally think that Bitcoin is going to have, annualized returns of, at least 25% for probably the next 15 to 20 years or so, in the 20 to 25%. And that's later on. So as it gets bigger, I think we're going to have these diminishing annualized returns.
It's going to taper down over time, right? Yeah.
Exactly. But it's still going to be, and this is the point. So lots of people get disappointed when they hear that. But I'm like, if you understand traditional investing, do you think stocks are going to do that? Do you think bonds or currencies or gold are going to do that? And I say, you're crazy if you think that. So it's still by far the best performing asset class. And that's what I tell people, like, look, you can have if you are put out by the volatility of Bitcoin, then just have a small position size in your portfolio. It's ridiculous to have no Bitcoin exposure at this point because it's not a career risk anymore. And so you can have like a 1 or 2%, and that will be volatile, yes, but it's more volatile to the upside. And I just think volatility is the price you pay for making life-changing amounts of wealth. And if you're not willing to pay that, then you're not going to have life-changing amounts of wealth for the most part. And so
yeah.
I encourage people to put as much as you can tolerate into your portfolio. I will tell you that the reason like my hedge fund has been one of the top performing hedge funds in the world from a multi-strategy perspective this year is because I have a very large allocation to Bitcoin and Bitcoin proxies. And that's not a fluke. And I think that it's not only is it not a fluke, I think it's going to accelerate in the next 12 to 15 months. And it's just going to absolutely leave behind traditional Wall Street funds that are in their stock bond portfolios. They're going to get decimated in the next 12 to 15 months. And all of them are going to wish they had Bitcoin at a much higher amount as this year progresses.
So perhaps a little more on the controversial side around timing the market. Now, the typical thing people say is don't time the market, time in the market, etc. But if you're operating in a liquidity framework, and let's say, as you say, you believe towards the end of 2025 or maybe early 2026, you start to think, okay, liquidity is going to start going the other way. Does that mean you actually lighten on your Bitcoin position, or how do you think about that aspect of it?
So this confuses people, and I always like to make this really clear too. So I'm two different people, right? I'm a fund manager, and I'm just a regular guy. My regular guy recommendation, and this is for 99% of people, just buy and hold Bitcoin and don't touch it and don't try to time it. And to your point, time in the market beats timing the market. You're probably going to be wrong if you sell Bitcoin because you think you're hitting the top or something. There are tax implications depending on where you live, especially in the US. It can be pretty rough. There are lots of ways that can go wrong. And so I recommend to everybody who's just a regular person, just buy and hold. Dollar cost average is the best strategy for almost everybody. And so that's my blanket advice. Now, as a fund manager, yes, I actually do try to time these cycles, right? And so like in my fund, after 2021, when I saw that the liquidity cycle was turning, I didn't want our fund to go down 75% or so, like Bitcoin did. I thought, you know what, there are ways to hedge against that. It's called a hedge fund. That's what I run. And so there are ways to do that. So yes, what I will be doing at the end, so if we have what I think is going to happen in just another kind of typical cycle, I think Bitcoin's going to peak into probably the fourth quarter. I'm targeting Halloween of 2025 as sort of the top date. That's just, based on past cycles and things. But who knows? I'll change it. I'm not holding that. I'll change it as the data comes in. But if it looks like liquidity is starting to roll over, global M2 had been increasing, but now it's starting to flatten out and probably going to head lower because of the economic cycles changing. And the Fed is starting to talk about overheated economies, stocks are crazy, irrational exuberance, those kind of things. I will start to get conservative. And the way I plan on getting conservative is to do things like buy puts at that point. So say Bitcoin is 400K. My target is 475K for this cycle. Say it's at 475K and I'm celebrating because I got the price right or close to it. At that point, though, I won't be looking at Bitcoin to go to 1 million. What's good? The most of the market participants are going to be just losing their minds at that point. They will be tripling down on leverage. They're going to be buying tons of calls, hoping that Bitcoin goes up to 1 million or 2 million or whatever they think it's going to do. And I will be trying to caution people. I'm going to turn back into Dr. Bear at that point and saying this is the time to hedge. And so in my fund, I will be timing it to your point. I'll be buying puts. I might take a little bit of trim my positions a little bit down and put them into treasuries or just hold cash at that point, depending on what the cycle looks like.
Yeah. And I'm curious where you came up with the 475,000 target.
I had a couple days where I just spent tons of time looking at past charts and past cycles and things like that. And when I kept coming to around that price target, so 450 to kind of 500,000, I wouldn't be surprised if I'm too low. I could see it actually spiking up, to 700, 800, even 1 million. I could see it tagging 1 million. If it did, I think at that point it will be way too overpriced. This is an easy sign for people that I feel like I wish I could put that from past experience, I wish I could give this knowledge to new and younger investors. When you see the price of anything hockey sticking and going exponential,
Right.
That's
You're
unsustainable.
close to the end. Yeah.
It's the end. That's the final huge dose of leverage before it crashes. And so I would just beg people to be cautious at that point and don't go all in if Bitcoin hits $1 million or hits 500K, because you're probably going to have a really miserable 2 or 3 years after that if you do that.
Yeah, and I will remind people, I've said this a few times, if you think back to, for people who are around in the 2017 cycle, people think of 2017 as just 20K. No, it started the year at like 1K or so. Yeah. It spent 75% of the year under 5,000. It spent 90% of the year under 10,000. It was only that last month or so that it really went from 10 to 20,000, and it just kind of briefly touched 20K and then crashed, obviously. And so a lot of people kind of misremember that, and they just kind of think of it as it was 20K the whole time. But no, it just kind of, it did that real hockey stick at the end. Now, I wonder if you think 2021 was maybe slightly different behavior. Maybe it was kind of lopped off a bit, or we kind of, China mining ban or something else happened that maybe stopped it.
Yes, that's my thesis, and I've written that a couple times. I think that the price in 2021 should have tagged about 125K. And I think it would have done that if it weren't for the China ban, which I think was really effective. I mean, it literally dropped the hash rate by 50% in about a month. That was incredible. And that was a real exogenous black swan hit to Bitcoin. And so by the time it recovered and started to ramp up again and liquidity started to build up and everything, unfortunately what happened is then the liquidity cycle turned and it peaked and started to roll over, and we could see that a recession was coming, unfortunately. And so I think a lot of people, including me, were disappointed. I was all prepared for the price to head up above 100 with my call options and things like that. And so that was a painful couple of months until I realized that the transition had occurred. I think it was a fluke. And I also think that if you have that mindset that it should have hit 125K, should have, I say in air quotes, then the current price behavior is very normal. What usually happens the year or two following is that you see this crab-like choppy movement about 40 to 60% of the former all-time high. And if that were the case, this whole price of kind of 45 to 70K is really normal. And that's basically where it should be before it takes off again. So a lot of people are saying this is a really abnormal cycle. We hit a new all-time high early. What's happening? And I say it's only because 2021 was a fluke that this feels abnormal. I think we're right on schedule. And I think as we head into Q4, November, December especially, and then into the 2025, that's when all the fireworks will start, and we'll see that, as you're describing, that kind of hockey stick ramp up. It'll be kind of low for a while, maybe disappointing, but then as we head into kind of third quarter of 2025, I think that's when the fireworks start, and that's when we start seeing that exponential move higher.
Yeah, and I think you had some really great comments on the investor psychology aspect of it also, because next year, if everything plays out as we are seeing it, people are going to be losing their minds, right? They're going to be thinking, oh, we're in a new paradigm. There might be new countries, new companies, big public companies, smaller companies who are all buying Bitcoin, and people will feel super bullish. They'll think, they're geniuses and they can't do anything wrong. Just, leave her on Bitcoin and you can't go wrong. And that precisely, sadly, is when most people will set themselves up to get wrecked. I'm curious, do you have any other, let's say, predictions or things that you think people will be doing at that point in the cycle that they should try to avoid?
Let's see, any additional stuff? Well, I think you hit on the main points, and I think kind of the point is at some point you just run out of buyers. There's so much optimism. Everybody is, not only fully max allocated, they're maxed allocated with leverage. So they're over leveraged and they're taking on risk that they can't afford to go wrong. When you hit that point and there's just simply no more buyers, that's the day you peak. And it's going to feel like the worst time ever to think about being conservative. But that's exactly when you should feel conservative. So I would just tell people watch there are ways to figure this stuff out. You can look at technicals that say something is overbought or oversold. I think these technicals will be screaming overbought at that point. You can look at a lot of on-chain indicators that show these, right? There's tons of things.
Like Circular and things like this, yeah.
Exactly. There's just tons of different things you can look at. But it's going to feel bad because what happens to people, and I know this from experience too from years and years ago, is you think you're smart because you'll sell Bitcoin, say if it hits like 250K, and you'll say, well, the indicators are starting to look like it's overbought and maybe I should. And you're going to feel like a genius because you're like, dude, I bought at 25K. I sold at 250K. That's a 10X. But then what will happen is literally the next week it's going to go up to like 400K. And you're like, oh, shoot, I sold too early. And so then you're going to not be able to take it anymore. And at about like 450, you're going to pile all back in again with leverage. And that's like exactly the wrong thing to do. So you got to just not lose your head when you hear people screaming that it's going to the moon when it's already basically gone to the moon. Just be careful, right? I mean, hopefully, maybe I can come back on your show at that point, and we'll talk about
ways, and you can, and then people will be hating on you, being like, "Oh, why are you so bearish? Why can't you be bullish like everybody else?"
They will. I get a lot of hate from being like that, but I literally just want what's best for people, right? I'm not looking for clients. I'm a doctor too. I'm not looking for new patients. I don't want you to subscribe to a newsletter. I literally have nothing to sell to anybody. I just want to help people to not make stupid mistakes. That's literally all I'm here for. And so if people hate me for that, like, that's all right. But I'm going to tell you what I think is the truth. And if I think it's overbought at that point and it could drop 80%, and I do, by the way. So my bull market price target is 475K. I think it could go back below 100K by the end of 2026. I think we could be back down to like 70K around where we are right now. And that would be just completely normal for Bitcoin. And I'm going to say that. And to your point, people are going to hate me and throw things at me and block me and all this kind of stuff. And that's just life, I guess.
Yeah, it's funny because at certain points in the cycle, you'll see on social media, people hate each other for not being bullish enough. They'll be like, oh, you're a bear, right?
Yes,
you're a bear.
yes.
Oh, yeah. Why don't you believe in 200K by conference day or whatever?
Right.
So one other topic I want to get to with you is the 8% withdrawal rate aspect, right? So people talk about, financial independence, and look, people shouldn't necessarily, it doesn't necessarily mean you have to retire early. Maybe it just means you work on something else that you want to work on. But I know you've spoken about this idea of withdrawing 8% of your stack per year as an example. Could you explain a little bit about that 8% number, how to think about it?
Sure. Okay. So first of all, this comes from, as an investment advisor, we talk about retirement ideas, and the goal of retirement is you want to build up your account according to some of the best research that says that you can live off of basically a 4% withdrawal rate for the rest of your life. And that way you won't outlive your money. That's the biggest fear that people fear outliving their money in retirement more than they do dying. So they're just terrified they're going to run out of money before they die. And so what a lot of research has shown that based on the stock bond portfolio allocation, traditional stock bond portfolio allocations, whether you're 100% stocks or 80% stocks, 20% bonds, or like 50-50, something like that, they show research that shows, historically speaking, basically a 4% rate is the acceptable rate, that there's a very, very, very low risk that you'll actually run out of money before you die, whenever that is. So, but now enter Bitcoin, right? So Bitcoin has these annualized returns that to date have been just ludicrously high. They've been super high, but they're clearly slowing down. So the way I look at it, and we talked about this before, is I think for the next 15 years or so, they're still going to be extremely high, but they're not going to be like the 2010s decade. I think when I did the research on that, the annualized return rate was about 180% annualized. That's crazy. We're never going to see that again. We might see it briefly during the bull market, but not over the longer term. I think this decade, we're looking at kind of like a 50%, 45 to 50% annualized return rate to the end of the decade. And then as we go into the 2030s to 2040, I'm looking at about 20 to 25%, somewhere in that range. So again, it's disappointing that it's slowing down. Yes, you're not going to become a billionaire because you go all in today, but that's still way better than stocks and bonds and currencies and whatever else or real estate, whatever else you want to invest in. So why do I say 8%? 8% happens to be double the 4% rate for stocks and bonds. And I think, by the way, that's very reasonable. I was called out, as we know, by someone for that being too aggressive and irresponsible. And I say, show me the math where that's too aggressive and irresponsible. You have to have a very, very low expectation of Bitcoin returns for the next 20 years if you think 8% is too high. I think it's going to be well above that. And I think that if you can say you've been fortunate enough to save up enough Bitcoin today, and you want to start living off of that, whether it's like an annuity, or you want to just supplement your income, or you're actually at retirement age and you want to retire and you have this large stack of Bitcoin, that 8% is livable. I predict and I think I can say this with a high degree of certainty, that you will not be able to spend that money fast enough, that the growth rate of Bitcoin will grow faster than your own personal consumption rate will grow. So even if you start to do things a little more fancy and you stay at nice hotels and you take an extra vacation every year, it will appreciate your purchasing power faster than you can spend it. And and I think that's just very reasonable, and that's very based on history and projecting that out into the future. Could I be wrong? Of course. Could the growth rate of Bitcoin slow to 10% or 5% going forward? For sure. But I tell you, that would be very disappointing to millions of people, and I think it would be very surprising to a lot of people. So I don't expect that at all. That's where I get that 8%. I think that's actually extremely conservative in Bitcoin terms. But I could be wrong. And it also depends on how much you have, right? I'm not saying for people, if you have 60% in stocks, 39% in bonds, and 1% in Bitcoin, then no, an 8% rate isn't appropriate. You should still stick to kind of the 4% rate. But if you have a large portion of your net worth in Bitcoin, then yeah, I think 8% actually is an appropriate withdrawal rate.
I see. And so the way you calculate that would just be, let's say, as an example, at the start of the year, you take 8% of your stack and you say, this is what I'm allowed to spend for my living expenses, hypothetically. And then next year rolls around again, you take 8% of whatever you've got. That's what you're allowed to spend. That's the way you're calculating that, right?
Exactly. Yeah. Yeah. Some people get confused by that. And so, yeah. So say you have 10 Bitcoin. After year one, you would take out what? 0.8
Bitcoin for the first year.
Bitcoin. Yeah. So then you'd have 9.2 Bitcoin left, and then at year two you take 8% of 9.2, whatever that is, and whatever dollar amount that is, by the way. So it is going to fluctuate a lot. Bitcoin is very volatile, but thankfully it's generally more volatile to the upside. And if you continue to do that, you will draw down your stack, but that smaller and smaller Bitcoin stack will be worth more and more in purchasing power.
Fiat purchasing power, yeah.
Right. Gotcha. And so that's kind of the whole point of it. So I don't really understand why people have an issue. Like, of course, you'll have less. Like, after 30 years, you'll be down to, I think it's like 8% of your stack. You'll have, if you do an 8% withdrawal rate after 30 years, I think you'll have 8% of your stack left. But if you have 8% of 10 Bitcoin 30 years from now, that will probably be worth tens of millions of dollars, if not more. And so, again, it's growing faster than your consumption rate. And so we don't have to keep talking about it, but
yeah, I see. Yeah, and as you're saying that as long as you're not crazy and buying like ridiculous yachts and private jets or whatever, like in practice for a lot of people, as long as you're reasonable, you're probably not going to outgrow that spending rate based on how much people are anticipating Bitcoin to go up. Compared to, if you just think about the amount of fiat debasement going on around the world, right? Like that there just will be this much fiat debasement going on. And so, yeah, I guess that's where the number comes from. But yeah, interesting discussion. And for people to, think about these numbers and just understand. I think it's important for people to run their own numbers, of course, and kind of be, do your own numbers, do your own budgeting, and really come up with what you think is realistic and reasonable. But of course, be prudent. So yeah, I guess closing it up then. Any final thoughts? Anything you think we didn't hit today?
I guess if I could leave people with anything, well, first of all, I'm fallible and I make mistakes. So please don't take anything I say as individual investment advice. These are just my best guesses, right? But I think that this is not a time to be bearish. I do not think this is a good time to be conservative. I do think that the recessionistas are wrong. I'll just flat out say this. And I listen to them. There are many smart economists who I listen to on purpose every day to get their bearish takes about how the world is about to collapse and we're headed into the worst recession the world's seen since 2008 or 1929. I just do not see that in the data I look at. And I think that data going forward is going to show as we head into 25 that inflation will bottom sometime around now and then slowly start to rise again, but not be out of control. And I think economic growth is going to start surprising to the upside. And then on top of that, we have central banks supporting the markets. And all of that means more global M2, more cash for people, more people starting to venture further out onto the risk curve. And I think that Bitcoin will be a big beneficiary. So I would just encourage people, please don't just sit 100% in cash on the sidelines, or please don't, and actually one more point, please don't short Bitcoin right now. Like for real, and this not because I think I want Bitcoin to go up. I'm saying you will get wrecked if you short Bitcoin during a Bitcoin bull market. And a lot of people are new to this space. My gosh, use stop losses if you do that. Be very careful. I hate to see people get wrecked. Just be smart. Dollar cost average into Bitcoin and chill, and you'll do fine.
Yeah. And actually, one other question just came to my mind. I forgot to ask it earlier on the whole 8%, retirement question. How would that play into it if you thought it was kind of towards the end of the bull cycle and you're kind of like, we're a bit overpriced? Is it really right to use 8% at this point? Or should you sort of maybe calculate that off of, let's say, a lower number than what it really is?
There are definitely better times, and this happens with anything. Like if you're doing a 4% rule with the stocks and bonds and those kind of things, and you're at a local peak, then you're gonna be making a lot of money in dollar terms that year, and then the next year you're gonna, my gosh, I have 50% less this time or whatever. So yes, if that's important to you, then I think it's important to think about timing the market a little bit as to when you start. But I will say that when you have enough Bitcoin accumulated or you have enough retirement savings accumulated, the timing shouldn't matter much. Even if you have kind of a flat rate of return, or like with Bitcoin, you have a large drawdown. Even if we have a large drawdown in 2026 and the price of Bitcoin comes back down to about 70K or 75K, it's probably going to start going back up again though. So you might have an unfortunate year, but you've only taken out 8% of your stack. And then you might have a lower dollar term rate that year. But then I think it's going to start heading up again in 2027. And I think by 2028, 2029, we're going to be talking about Bitcoin at $1 million or $1.5 million, somewhere in that range at the next bull market, peak. And so all these numbers now are kind of moot as long as you're just having a conservative rate of withdrawal, whether you see it as retirement or as an annuity or just as supplemental income, like rental real estate income that a lot of people do in the States. It fluctuates, but in general, it's going to move higher over time, and it will eventually reach a point where it's a lot more 10 years from now than it is today for that same 8%.
Fantastic. Well, a really interesting discussion, and I will encourage listeners to follow Dr. Jeff on Nostra. So your Nostra account or handle, I guess, or pub key, I'll put that in the show notes. But Great. It's Dr. Jeff at nostraplebs.com. And Jeff, thank you for joining me, and I enjoyed the chat today.
Thanks for having me, Stephan. It was a fun conversation.